taking the bull by the horn, riding those waves. That's what people think investing the market is. And oftentimes we can make it that way because we bring emotions in with us when we are dealing with our money, which is totally human, right? It feels like that roller coaster that will never stop. When the market's going well, I hear from clients all the time saying, how can I invest more money? And then when the market's not doing so well, I hear, ooh, should we pull out? Should we pull it to cash? What should we do in this scenario? Now, I really wish that we all followed the basic rule of investing, which we all know it, and you can say it along with me, which is sell high and buy low. That's the way you handle the markets. But when I tell you that I hear from people and say, how can we invest more money when the market's going up? Is that selling high? No. What should we do? Should we pull out of the market because the market's falling apart? Is that buying low? No. But people don't want to do that during that time. They know intellectually they should be doing that. But instead, their emotions push them the opposite direction. And this is what happens when you're investing in the markets in general, but especially during kind of a tumultuous time, which I would say right now, we're in kind of a strange time. There's a lot of different economic news coming out, some not so good, some better than others. Businesses seem to be doing okay. But at the same time, inflation's still high. Things cost a lot. The price of oil is going up and down. So gas prices are going up and down. And it can be very overwhelming investing in a time like this, especially with the presidential election at the end of the time. Now, I'm not going to go into who would be better to win the election for the markets, because actually there's data showing that there's really not any historical news on that. If it's a Republican or a Democrat, it doesn't seem to make that much of a difference of how the market reacts. So it's just a tumultuous time because there is a presidential election, and not just presidential, but many elections happening in November of 2024. So what can we do? How can we become more like this? Now, I got this as a present from a friend many years ago, and I love it. It's a little girl who is taking on the bull. She is staring him in the face and saying, I'm not afraid of you. And that's all what we want, right? We want to feel like this little girl with no fear. And I believe this is actually someplace on Wall Street. I've never actually seen it in person, but I just love that photo. And essentially, that's what we all want, right? We want to be that little girl standing there tall and proud and saying, how do I take you on and not flinch when you come at me? And so that's what we're going to discuss today. We're going to discuss investing in a tumultuous market and how do we put a strategy in place that we can actually stick with and keep to during those emotional times. Now, who am I? I am a financial advisor. I have been doing this for 13 years, a little over that now actually, and I help people get to financial independence as quickly as possible. And part of that is helping them with their investments, whether I help them personally and I help them do the trades and that kind of thing, or I'm helping them from afar and I help them through, just Zoom and helping them figure out how to invest for themselves, and then they go in and do the trades. It doesn't really matter to me as long as I'm helping them get to what they want in their personal goals. So we are going to talk about investing during an uncertain economy, which this is. And with this video, you're going to get some good strategies of what to do, how to react, what are some things you can put in place. Now, are all these strategies perfect for everybody? No, they're not. And so I would suggest that if you have a financial advisor or if you have somebody that helps you with your finances, reach out to them, ask some questions, have a dialogue. Some of these videos are really for that. I want people to have those engaging conversations that maybe we're not having nowadays, right? So understanding an economic uncertain market is really interesting because they're all different, right? So I've gone through a couple of them. One in particular was 2020 during COVID. That's a very interesting market, and I will use that as an example of how investing in the markets can be strange during times like that. Because if you look at when the market was really falling apart in 2020, It started in, probably, I'd say January, January, maybe late January. The market started to slip based off of some news of some virus. And I had not heard much about this. I'd kind of heard about it, but, we'd had the pig flu and we'd had, like all this, it's not called the pig flu, is it? It's the swine flu and all these different things out there before. SARS was supposed to be this big thing. I remember I'm part of a women's group, and I remember the head of the women's group was at a function that we were all at together, and I think it was in February of 2020 before everything shut down. And she's like, I heard all about SARS, and we had to, they were trying to cancel flights and all this stuff, and I just kept going, and we just kept getting through it. And so nobody really understood what was going to truly happen during 2020, but the market did. The market was going down and down and down and down, right? And that was a hard thing to discuss with clients, because I'm trying to explain to them how the market is anticipating something bad happening. But they're saying nothing's really happened, like we don't really know. And I said, yes, but the market anticipates forward what they think is going to happen with business and the economy. Now, the strange thing is that March of 2020, we had the shutdowns. Everybody stayed home from work. Businesses were closed, or people working from home, hopefully, and keeping businesses going. We all had to wear masks going to the supermarket. This was not that long ago. You probably remember all of this. I remember actually taking a picture of myself in my big old mask going into the grocery store to show my husband I was actually doing it. It was a weird time. It really was. And so essentially about 2 weeks after the businesses sheltered, everybody stayed home, the market started to turn upwards. After months of turmoil and down, 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 the market starts to turn. About 2 to 3 weeks after we closed down. Now, why is that? We had just closed down. We have not seen the economic turmoil that's going to happen from this, right? Well, the thing that happened is that the market went, it can't get worse. So I see positivity coming down the line, and it turns. Markets are very forward thinking, and that's what we kind of forget. We think that markets are reacting just to right now, and sometimes they are. The markets are strange right now because they have algorithmic trading, which means that a lot of funds are traded from computers, and computers are getting put, the headlines of the day are getting put into it, and they make trading decisions based on those. And so it can make the market very turmoil in terms of, like, an announcement happens from the Fed and then the market shifts dramatically because of that. But in the long run, when you are looking at a longer term in terms of the market, it is very forward looking. And so when that market started to churn up in March of 2020, when we were still in lockdown, it was because it saw that things have to get better. The economy is going to have to get better. And it did. We recovered quite quickly, actually, in the economy, and the market skyrocketed. I mean, we had a positive market in 2020, and a very, very nice positive market in 2020. And nobody would have anticipated that if you were talking to them in February of 2020. It seemed like a horrific time to invest. However, that was a great time to invest, right? Buy low, sell high, and you don't have to sell. You could just hold high if you wanted to, but buy low is the strategy. And yet so many people were so afraid to put money into the market during that time, which makes sense because it was uncertain. And so what are things that you can do to kind of hedge against this kind of thing? How do you take that time like 2020 and talk about like the different things that you could be doing to hedge that and to make it so that you feel better about not being so emotional about this? Your emotions are going to happen, but how do you hedge against that? How do you have that wall that you're pushing against going, okay, don't do that. You already have this stuff in place, right? So one thing you can do is diversify. Now, I know you're going to roll your eyes. Everybody rolls their eyes when we talk about diversification. It's just the way it is. But diversification is boring because it's the truth. If you own everything in one sector or one stock or just a couple of stocks, you are much more susceptible to downturn risks getting very, very hard to deal with than if you're diversified. If you have some in real estate and some in commodities and some in energy and some in tech and some in robotics and some in, if you have it all over the place, then you're not going to get hurt as badly when the markets go down, because typically all sectors don't slide in the same fashion. They might all go down. Like 2022, I would say most of the sectors went down, but there were some sectors that did okay. There were some sectors that didn't go down as far as other sectors did. And so you kind of help your portfolio not slide as far down than if you are just holding the S&P 500. Now, I hear a lot of people saying index, 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 and I have some clients that love to index. But you are taking on a risk by that, because oftentimes those indexes are just certain sectors, certain areas of the market that they're showing as an index. There are not that many indexes that are full conforming to the entire market and diversified. So just keep that in mind. That is one thing when you are indexing, that you are kind of taking out some diversification sometimes out of that. The other thing is finding those gems in the rubble. So that's often called value investing. But what that means is there are some stocks, there are some things that are doing pretty well in bad economies. Businesses did better sometimes when 2020 hit, and some businesses flourished and some businesses closed, unfortunately, and that's just part of it. So if you can find those gems during a downturn, those are the ones that you want to push into. But, everything was down. I remember, Zoom was down, Apple was down, everything was down, it seemed like, during 2020. And if people pushed in, not just specifically for those stocks, but in general, if they pushed into the market, they were pretty happy with the results by the end of 2020. Now, I am going to say 2020 is a very unique period. The reason I'm talking about it is because it is such a short period of time. However, 2022, we took all of 2023 to recover. All of 2023. You don't typically recover within like 2 months like we did. It probably was longer than 2 months, but 2020 was a very fast recovery plus an escalation, which, 2022 we went down and 2023 was recovery. So a lot of clients are like, well, why am I back to the same levels? Because it took an entire year for us to recover, and we're still technically kind of recovering a bit. Oftentimes it will take 12 to 18 months for a market to recover from the down historically speaking. From the lowest point to the highest is typically, 18 months historically. So you just have to kind of keep that in mind. You also have to keep in mind your risk. A lot of times we do this shiny object syndrome. I've talked about this a lot. And we start chasing things because it's doing really well. Like Zoom was one of those ones during 2020 that people were just chasing and chasing and chasing, right? They were like, push in. It's Zoom. Everybody's on Zoom. Do Zoom. Zoom, it's funny because by the time a lot of people wanted to push in by like July, August, it had kind of plateaued and it didn't move for a long time. From my recollection, I haven't looked at it for a while, so maybe I might be wrong. But from what I remember, it plateaued for quite a while and it didn't really go anywhere, and it went down actually a little bit. And because, again, markets forecasting, they don't forecast that it's going to do better than what it's done. And by July, August, it had kind of done its thing. Everybody who was going to use Zoom was on Zoom already, right? So if you wanted to push in September, you might have been too late for those things. And that's okay, because maybe Zoom is too narrow of a niche. Maybe you shouldn't be in that arena, right? Not everybody should be stock picking or all in stocks. Sometimes you've got to balance it out with some fixed incomes, some treasuries, some other things to make sure that you're in the risk profile you're supposed to do, because essentially nobody likes to see the value of your account going down. I'm not going to say that you're losing money, because that's kind of, to me, a fallacy people say is, I'm losing money. Technically you're not, because you haven't sold out. You still have the same number of shares of whatever you have before. Those haven't diminished in they haven't diminished in number, they've diminished in value, but that doesn't mean that those values aren't going to go back up. So you're losing value on paper, let's put it that way. And essentially when you lose value on paper, it's very, I mean, nobody likes it. I didn't like seeing our accounts going down. I mean, I don't like that stuff, right? Nobody does. Didn't like having those conversations with clients, of course, you know. But at the same time, when you see things going down, that might be an indicator that A, where are we in terms of risk? Are we in the right risk category? But B, should I be buying into the markets? That's another indicator. So instead of seeing it as such a negative, instead think of it as an intellectual. Unless you're selling at that moment, you really haven't lost any of your shares. You've lost value, the shares have lost value, but you still hold the same number of shares. And so when you see things go down, maybe take that moment of, ugh, and turn it into an opportunistic idea. You know, think of it as, maybe this is a good time to buy. Maybe this is a good time to lean in. Maybe this is a good time to diversify a little bit more. You know, those kind of things could make those downturns feel a little bit better, because you feel like you have a little bit more control. Now, that's all going to be dependent on your time horizon, where you are, if you're in retirement, if you're still working and you're building. That's going to all change because of those kind of, you know, where you are in your situation. But oftentimes, if you can take a bad situation like a market downturn and try to turn it into a good opportunity or a good situation for yourself, you are going to be doing better than 99% of the other people, because they don't want to do that. They want to feed into the turmoil that happens. And when you're in kind of a strange economic time like we are, there's a lot of feeding into this. There's the news outlets. Everybody seems to be feeding into this down market. Markets got to go down. Interest rates aren't going down, so markets are, you know, going to have issues, all this stuff. There's news, and the news is entertainment. So just keep that in mind as well. But if you can take those turbulent times and kind of turn it on its head to something more optimistic, and something that you can actually have some control in, and make some changes and make some moves that maybe you wouldn't necessarily do in the past, that might be a good way to get through times like this. But, you know, really, it's mastering the psychology of investing. It's always difficult for most people. Even the best investors in the world tend to make some mistakes. Warren Buffett has made several mistakes. He took a long time to get into technology, a long time. He's still done fine, but he could have done better, obviously, if he had kind of leaned into that. But that area scared him. He didn't know anything about it. He said he didn't know anything about it. And he took a long time trying to learn before he'd invest in it. And maybe that's a mistake, you know, but in the long run, he turned out okay, because he actually did take some action at some point. So when you're doing these kind of investing during turbulent times, really think about diversification, having a strategy in place, seeing these downturns as opportunities or as a positive rather than a negative. If the market just keeps going like this, there's going to be other issues that are going to happen. Markets are going to do this because it's business. Business goes up and down. If you're a business owner, you know. 1 year you have a great year, and next year you don't have such a good year. You know, 3 years in a row you don't have a good year, and then you have a superb year. It's just the way business happens, and the markets are business, right? You're buying into businesses. That's what happens. And so as you go through 2024 and any economic turbulent time, you just have to kind of keep in mind that you have strategies. You know what your risk is. You know when you're going to invest. You know how you're going to see things. You've mastered your psychology of investing. And with those kind of things under your belt, you will do very well because you are actually being, what I have heard from a mentor of mine, is a conscious competent. You're conscious and you're being competent and you're being aware of what's going on rather than everybody else who is just kind of sticking their head in the sand. And that's really the key, is being aware of what's happening, being aware of the emotions that are involved, and acting accordingly, and being this little girl rather than what we usually are, which is just kind of running away in the opposite direction. So with that, I hope that this helped. I would love to hear your situations, your stories, anything that you'd like to share about investing in a turbulent market. It's scary for all of us. And I'm sure you've got some great stories. Maybe you're not so happy with the stories. Maybe you learned something. Please share, because I would love to hear, and I'm sure it would help so many other people out there trying to just navigate the bumpy waters. It's not really bumpy, but it's the word I'm trying to say. The raging waters, I should say, of investing. And with that, obviously always kind of reach out for professional help, get some ideas, different things. A lot of us are out there that are willing to meet with you for an hour to get an idea of your situation, help you if that's all you need. If you want more of a professional relationship, there's tons of us out there that work with clients for years and years and years. And the next one is going to be a really interesting topic. We are going to talk about rental property investments, and are they cash flow positive or just a headache? And that is a controversial issue, but we are going to go through the pros and cons of rental properties. So with that, thank you so much for watching. This was a long one, but I hope it was helpful, and may you do well in your investing journey.